Did you know that the amount that you pay for Medicare Part B and Part D is based on your income? So let me say that differently. If you're not proactive, if you're not planful with your tax picture, you might pay more for your Medicare than you otherwise would. Oh my goodness, I'm going to help you prevent that and plan for it. That and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So while I'm recording this, we're in the middle of tax season. I had an individual I met with yesterday. They're 68 and 70, okay? It's a couple, and they've worked hard. They came from modest upbringing, okay? Basically grew up poor, and both worked extremely hard, stayed at the same job for their entire careers, each of them, and they retired multimillionaires to about $2 million bucks, which is just, I love those stories. I just love it. Well, they hold a lot of different investments, and last year, because of the stimulus and changes, they didn't need to do a required minimum distribution for the older one who was 70 and a half, and anyway, those laws changed anyway. But he was nervous about how high his Apple stock was getting, and so he wanted to sell a chunk in the fall. And selling a chunk brought about $100,000 of capital gain on their tax return. Between that $100,000, their Social Security, and a small pension, their adjusted gross income came in at about $168,000. And I pointed out to them when I was delivering their return that how close they were to having to pay extra on their Medicare Part B and Part D premiums because of how much reported income they had for tax year 2020. Can you believe that? So that's a real life example, happened to me yesterday, of a situation where someone could have, just because of a different issue in their financial life, a desire to say, hey, Apple stock's getting a little high, maybe I should trim some, that could cause them to pay more for their Medicare Part B and Part D. That is just craziness. Your entire financial life is integrated. It just is. That's why we preach to you every day that all 6 areas of your financial life need to be considered when you're making big financial planning decisions, even if you're 30, even if you're 40, even if you're 50, because all of that, those decisions you make today in your finances, they will all be connected in the future for your planning options. So here's the deal. Yes, based on your income in retirement, that will influence what you pay for Medicare Part B and Part D. Check out these charts. Let's look at Part B first. If your income for a individual is $88,000 or below, or a joint taxpayer is $176 or below, you're going to pay the normal rate. It's $148.50 per person per month for Part B. However, if you get a little above that, and let's look for a joint tax return, if you're above $176,000 but below $222,000, now you have to pay more. You have to pay $207.90 per month. That's almost $60 more per month. They call that an income-related monthly adjustment amount, or IRMAA. And IRMAA, that's a bad acronym, okay, in your financial life. So you're paying more. I'm all for paying more and getting more. You're paying more and you're getting the same thing. That is a bad deal. So that's just a $50,000 window, okay, from 176 to 222. If you're over 222,000, between 222 and 276, this is a married filing joint, you pay double. Instead of $148.50, you pay $297. And then you can see that thresholds go all the way up until over $500 per person per month if you've got big income. That's Part B. Part D as well. Let's flip over to that chart. Part D, if your income's above that first threshold, you're into that first tier or second tier, you pay an additional $12.30 per month per person for your drug plan. If your income's in that 222 to 276 range, you're paying an extra $31.80 per month per person, simply because your income crept too big for that certain year. And what year are we talking about? Prior year. Okay, so for for calendar year 2021, you're looking at your tax picture from the prior year. So for calendar year 2021, the prior year would be 2020. The prior year would be 2019. So your tax picture in 2019 is influencing what you're paying for your Medicare Part B and Part D premiums in tax year 2021, calendar year 2021. Make sense? Maybe not. Okay, so here's the big idea. I think if you've understood this thus far, you would know, and I even said, IRMAA, that's a bad acronym. You want to avoid that. You want to do as much tax planning as possible to pay the base rate for your Medicare Part B and Part D. You don't want that surcharge. You don't want that income-related monthly adjustment amount. You don't want to pay more for the same thing. So what are the major reasons why you might be subject to IRMAA, subject to a higher cost for your Medicare Part B and Part D? And I want to point these out so that you can avoid them, okay? I've got the top 5 reasons why you might be subject to IRMAA in the future, and therefore you can be planful in your approach to avoid these, okay? Number 1, the primary reason, the primary example we see to someone all of a sudden being subject to IRMAA, subject to a higher cost for their Medicare Part B or Part D, is because they simply took a large distribution out of their IRA, out of their retirement account, out of their pre-tax retirement account. They wanted to buy a new car, and they didn't realize that their income was connected to the amount they pay for Medicare Part B and Part D. They weren't doing comprehensive financial planning. They wanted a new car, they took 40 grand out, all of a sudden that moved them into the next tier. They wanted to do a big home improvement. They took 50 grand out, and all of a sudden they're in the next tier. They wanted to move, and they wanted to buy the house before they sell their current house. They needed a down payment. Instead of doing a line of credit, they took a big chunk out of their IRA, said, no, it's no big deal, or when we sell the house, we'll put the money back in. Whammo, all of a sudden they've got big income on their tax return. So not being planful, not being proactive, and taking a big withdrawal out of your IRA. That all of a sudden moves your income up in that year, and you don't realize it, but the 2 years following that, you get this letter about an income-related monthly adjustment amount, and now you've got to pay more for your Medicare Part B and Part D. Be planful with this. Be aware of what the threshold is, how much you can take out without going into the next tier. And if you need $40,000 to buy the vehicle, consider taking 20 grand out this year and 20 grand out in January 1st of the next year. And in doing so, if 20,000 is the right number to keep you below that threshold, voila, done, okay? So that's the first reason why people accidentally fall into paying more for their Medicare Part B and Part D, is they take a big chunk out of their IRA. The second reason is the example I just mentioned. For an investment-related reason, you want to sell an investment or rebalance an investment or whatever, and all of a sudden you have big capital gains on your tax return. This is the reason why while you're saving up, I want you saving up in tax sheltered accounts, right? I mean, in the first example, if you draw money out of your Roth IRA instead of your IRA, that money does not land on your tax return. It does not cause you to pay more for your Medicare Part B and Part D premium. Same thing here. If you wanted to, from an investment standpoint, if you're like my client looking at Apple saying, gosh, it's at a pretty high price to earnings. It's had a huge run here. I want to take some chips off the table here, sell at these prices. If that Apple stock is held within your IRA or within your Roth, there's no capital gain to speak of when you sell it. But if it's outside, in this particular case, it was in a trust account, selling that creates a capital gain. So making an investment choice to sell something that has a capital gain, that's the second most common reason why all of a sudden you're going to have to pay more. You might have to pay more for your Medicare Part B or Part D. The third reason, the third culprit, is required minimum distribution. I mentioned in this example, they're 68 and already 70 and a half, 71, I believe is where she turns. And so I was explaining to them, listen, If you wanted to trim more of your Apple stock in the future when you're both on required minimum distribution, that's going to move you up into the third tier. So I said, even though Apple, since you sold it, has been sort of lukewarm, it hasn't really gone down, gone up, you've had a lot of capital gains, and you might say, gosh, maybe I shouldn't have sold it. Just know that if you did that in the future when you were subject to required minimum distribution, you'd have to pay more. Okay, so required minimum distribution, likely for a lot of people, depending on your pension, depending on your other sources of income, could push your income, your adjusted gross income, into that next tier, cause you to pay more tax, or excuse me, more cost for your Part B and Part D premiums. That's the third reason. The fourth, if you still held a small business, you still owned a small business, maybe a rental property or a couple rental properties, and you're using that for some income early in retirement, you've transitioned, you're on Medicare, and you've just got this side income happening, and then all of a sudden after a few years, you sell out or you sell the business or whatever, now all of a sudden you've got big income in that year, and you're going to be subject to this higher Medicare cost for Part B and Part D. And then the final reason, the final culprit, the final primary reason why people are suddenly subject to IRMAA or an increase in their Medicare Part B and Part D cost is they're suddenly single. In their retirement years, in their Medicare years, they get a divorce or there's a death of a spouse. And as you recall from that grid of, at what income level are you subject to this income-related monthly adjustment amount? If you're single, you're allowed less income before you hit those higher payments than if you have a joint tax return. So if you're all of a sudden divorced or widowed, then that's going to influence things. Okay. The idea behind all of this is be planful with your taxes. So now you've got those top 5 reasons. Be mindful of those. Be proactive with those. How can you apply this information? Number one, no matter where you are in your financial life right now, be aware that your Medicare Part B and Part D premiums are influenced by your income. So if you're in the savings years, make sure you're funding that Roth IRA. Make sure you're maximizing that HSA. Try to shoebox it so you've got those accounts growing tax deferred and tax free in retirement, won't cause an IRMAA situation. And if you're in retirement, be mindful that if you make a big withdrawal or make a big sale for capital gains, or you have a small business you're going to sell, something like that, it could impact your premium for your Part B and Part D. So you need to be planful, work with your certified financial planner on that. So that's the first one. Second, again, I would just go back to make sure you're using that Roth IRA and HSA. Make sure that you're considering Roth conversions for your IRA. Make sure you're funding that HSA and even maybe considering that once in a lifetime move from your IRA to your HSA. So be planful for that. And then third, if you've been subject to IRMAA because of some sort of accident or once in a lifetime event, the IRS and Medicare does actually allow for some exceptions, okay? I'll link the form below. Now, the exceptions aren't, oh, I didn't know, right? That's not gonna work. They've got a list of about 7 different reasons why you can say, yeah, can you grant me an exception and not increase my Medicare Part B and Part D? So I've seen some folks have success filling out this form. I've had others where it seems logical, yeah, they're going to give you that exemption and the IRS doesn't. So link it below. Don't plan. Don't just assume, well, I didn't know, they'll probably let it slide, I wouldn't plan for that, okay? But just know that that is an option. Work with your certified financial planner. This is one of the major reasons you need comprehensive financial planning. We're talking about tax planning. We're talking about protection planning, your health insurance. We're talking about investment planning. Should you buy or sell investments, capital gains, use of tax shelters, IRA, Roth IRA. We're talking about cash flow planning. How do you pay for that next car, pay for that addition to the house? Do you draw it out of this account or that account? And then retirement planning. How much can you afford to draw? What are your income sources? Those are 5 out of the 6 areas of your financial life, all impacted by this one rule. Work with your certified financial planner and receive guidance and wisdom into your financial choices about bringing synergy to all 6 areas of your financial life. You don't have a CFP on your team? Contact one on my team. Find us online, Korhorn.com, that's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.